Hello, so here's the market report for January 2026. I first of all just want to say thank you for being a client in 2025. We look forward to 2026 with some optimism, but the first priority is going to be to preserve capital, and secondly, take advantage of any opportunities that come up in the year. So as a reminder, what do we want from investments? We want a better chance of a positive return and less risk. So we're looking at the risk-reward ratio. We want to take this much risk and get this much reward. And the number one golden rule is only buy good value. What is good value? It's when the PE ratio is 15 or less. Why 15? Because it's the long-term average. A PE of 15 means average risk, average chance of a positive return. Less than 15 means less risk, more potential. And the PE right now is 21.8, so it's bad value. There's a bit of a recap on the market, share market for the last 12 months. So you had a big drop here when Donald Trump started his tariff war, and then it's recovered quite strongly, but now it's in a bit of a downward trend. So the target for good value, the All Ordinaries is currently at 9,009 with a PE of 21.8. And we're looking for a target of 6,649, which is actually a PE of 16. But the reason why we've gone for 16 in this case is because the PE ratio for the next, looking for on earnings for the next 12 months is very strong. But it still has a long way to fall to be good value. In the US, PE ratio is 23.1, which is exactly the same as last month, and global markets 21.2. And the temperature is still on the cold side, terribly bad, but it's not hot. And this is where we buy. Cold is where we not so keen on buying, and even the colder it gets, we might sell. The future. Is it all doom and gloom, or are there positive signs? Well, interest rates, this is the average of the big four banks' term deposit rates, and these guys get it right 80% of the time. It's their job, they do it all the time. They have to make a profit, and they always make a profit, so they're good at it. You can see here that the longer term rates are lower than the shorter term rates, but not that much. This is about 3.8, and that's around 3. So interest rates will probably fall a bit through the next 4 to 5 years, but they may rise a little bit in the next year, but probably hold still is my guess, and then begin to fall again. Earnings growth. The earnings for companies in Australia is expected to grow by that much. In the US, this much, which is huge. There's a lot of positivity over there, at least in their expectations. And in the world, it's 8.4. Small companies lag. This is looking at whether, how much run the share market, how much up movement the share market's got in it, or how close it is to the end of a upwards run. Oops, sorry, went ahead too fast. You can see large companies usually go up more to begin with, because that's where people look for value and buy into the larger ones, and then once the larger ones have been gone up, then the smaller ones catch up, and that's like a sign that the market's getting overheated because there's nothing left to buy. In Australia, the small companies are actually in front of It's not a lag, they're actually in front of the larger companies. In the US, smaller companies are 23% behind, and in the world, 41%. So, not that much positive there for Australia, but the rest of the world, yes. Fear factor, about 50-50 at the moment. And this one measures, okay, if we're going to do something, how fast we're going to do it. Now, looking at the value adjusted risk reward ratio, it's a ratio of what you could lose, which is risk, and what you could gain, which is reward. And it's adjusted for the value of the market. Currently, with the portfolios we hold at the moment, the potential reward is 7.4 and risk -3. This is a potential loss for the year for a conservative portfolio for an average size fall in the markets and adjusted for the current value of the market. And this one is the reward, potential return for the year for a conservative portfolio based on historical returns and adjusted for the current value. And there it is again. So the ratio is 3.3 to 7.4, which means the reward is 2.2 times the risk. And that's a good place to be, in my opinion. This is for a conservative portfolio, but it's important to remember this is an educated guess based on history. It's just a likely range, but really anything can happen, has been shown in the past with COVID and that sort of thing. But if things just go according to history, it shouldn't be too bad. My prediction, markets will go up or down or sideways. I cannot predict what markets will do. I can say they are poor value and we want good value. So in summary, Australian shares are poor value, US shares are poor value, global shares are poor value, which means we won't be buying anything till they're good value. And the risk reward ratio is 2.2, which is acceptable for a conservative portfolio. General advice warning, this information is for general information only. And whilst all care is taken, there's no guarantee that the information is correct, but I do take a lot of care to make sure that it's as good as I can possibly get it. And it's really important before acting on any of the information included in this presentation, should get specialised advice for your situation because everyone's different. So thank you. Let's hope we have a great new year. We get that 7.3 or 7.4, not the -3. But once again, we'll be focusing on preserving capital and being ready to take advantage of any drops in the market. But they will have to be big drops. Okay, have a great day.